On Sunday night, August 15, 1971, Americans were not watching a collapse. They were watching television. Then President Richard Nixon interrupted programming and announced that he had directed Treasury Secretary John Connolly to suspend temporarily the convertibility of the dollar into gold. In the same address, he reassured the public that this would stabilize the dollar, and that for most Americans, the dollar would be worth just as much tomorrow as it is today. Picture this. Sunday night, August 15, 1971. You're watching your favorite TV show when the president appears to tell you that the dollar will be temporarily stabilized. You don't realize it, but the anchor of the world has just been cut. By the end of this video, you will understand the de-anchoring pattern that precedes every reserve currency collapse and why the signals we see today are an exact match for 1971. That was the fracture. Under Bretton Woods, the dollar was not just another national currency. It was the hinge of the post-war monetary order. Other currencies were fixed to the dollar, and the dollar itself was tied to gold at $35 an ounce. By the 1960s, too many dollars had been pushed out into the world relative to the U.S. gold stock that was supposed to anchor them. Foreign governments held claims the United States could no longer honor cleanly at the official price. And this is the first rule in the forensic record. When a government says the break is temporary, study the incentives, not the wording, because once a reserve currency is cut loose from discipline, the loss does not arrive as a headline first. It arrives later in groceries, wages, rent, savings, and the slow discovery that your money still counts dollars, but no longer measures reality. The official language was technical. The actual change was civilizational. A temporary suspension sounds like a pause. It sounds administrative. It sounds reversible. But in monetary history, that word usually appears at the exact moment a state is buying time to cross a line it already knows it cannot uncross. That is the pattern. First, the promise becomes difficult to keep. Then the language shifts, not failure, not default, not rupture. Suspension, adjustment, emergency measure, temporary stabilization. The public is told the system is being protected. In reality, the system is being rewritten, and that distinction matters because people prepare very differently for a delay than they do for a regime change. If you tell the public a bridge is closed for repairs, they wait. If you tell them the river has moved, they leave. In August 1971, Washington did not present the end of gold convertibility as an admission that Bretton Woods had become mathematically unstable. It presented the move as a defensive action against international money speculators, as though the problem was external pressure rather than the internal contradiction of issuing more claims than the anchor could support. That rhetorical move is not a footnote. It is part of the mechanism. When institutions cannot preserve the old standard, they preserve confidence instead. Or, more precisely, they try to preserve confidence long enough to build the next standard before the public understands the old one is gone. This is why normal people usually recognize monetary breaks too late. On the night of the announcement, there was no bread line outside the supermarket, no empty ATM screen, no dramatic collapse in the family checking account by sunrise. Paychecks still arrived. Prices did not instantly explode. The dollar still looked like the dollar. The symbols of continuity remained in place long enough to conceal the break underneath. And that is how de-anchoring works in practice. The note in your pocket remains familiar. The payroll system still functions. Treasury markets still trade. News anchors still use the same language of reassurance. But the measuring rod has changed quietly. The unit that once represented a claim restrained by something outside politics becomes a claim restrained mainly by policy discretion, geopolitical necessity, and public tolerance. That is why temporary is such a dangerous word in financial history. It does not describe the duration of the change. It describes the window in which most people fail to understand what has already happened. To understand why Nixon closed the gold window, you have to look beneath the speech and into the arithmetic trap beneath Bretton Woods. The post-war dollar system contained a contradiction from the beginning. For the world to grow, trade, and settle accounts, it needed a rising supply of dollar reserves. That meant the United States had to keep exporting dollars abroad through military spending, foreign investment, overseas commitments, and trade deficits. In other words, the world needed more dollar claims every year, but for the dollar to remain trustworthy, those claims had to look convertible into something politically harder than paper. Under Bretton Woods, that something was gold, and there was the problem. The more successfully the United States supplied liquidity to the world, the more it undermined confidence that each external dollar claim could actually be honored at the official gold price. The system required abundance and credibility at the same time, but abundance steadily destroyed credibility. That is the Triffin dilemma. In plain language, the reserve issuer must feed the world with its liabilities, and by doing so, it slowly poisons the promise backing those liabilities. By the late 1950s and into the 1960s, this was no longer a theory. It was visible in the numbers, in the pressure on U.S. gold reserves, and in the growing unease among foreign central banks. Dollars were accumulating outside the United States faster than the underlying gold base could credibly support. The official structure remained in place, but the mismatch was widening year by year. Then the second layer of the trap appeared. Washington had domestic reasons to prefer ease over discipline. Cold War spending, Vietnam, Great Society expansion, and the political cost of tighter money all pushed against the hard requirements of a gold-linked system. A true defense of the dollar's external promise would have required harsher choices at home, tighter credit, fiscal restraint, slower growth, and a willingness to impose pain now to preserve credibility later. That is rarely how democracies behave when the bill for excess can be deferred. So instead of resolving the contradiction, the system tried to manage it. Gold pooling arrangements, diplomatic pressure, capital controls, currency coordination, reassurance, delay, more language, more patchwork. Each fix was designed to preserve the appearance of order without removing the underlying imbalance. But once foreign holders understand that claims are outrunning the anger, rational behavior changes. No central bank wants to be the last one holding paper when redemption credibility disappears, so the incentive shifts from cooperation to exit. Quietly at first, then all at once. Each actor has reason to redeem before the others do. What looks like a confidence problem is really a Q problem. Everyone does not need to run. Only enough major holders need to realize that waiting is irrational. That is what forced Nixon's hand. He was not simply confronting speculators. He was confronting a reserve architecture whose internal logic had reached its limit. The United States could either defend convertibility by imposing domestic austerity severe enough to restore confidence, or it could preserve domestic and geopolitical flexibility by breaking the external promise. It chose flexibility, and once you see the mechanism clearly, 1971 stops looking like a strange one-off historical event. It starts looking like the standard political response to an exhausted monetary order. When the anchor becomes too costly to defend, governments do not usually confess that the system has failed. They redefine stability, cut the rope, and tell the public the ship is safer now that it is drifting. One of the most dangerous features of a monetary break is that the public often expects immediate pain, and when that pain does not arrive overnight, they assume the warnings were exaggerated. That is exactly what happened after August 1971. If the dollar's anchor had really been cut, why didn't grocery prices explode the next morning? Why didn't households feel the full shock in 1971? Because de-anchoring and consumer price transmission are not the same event. On the very night Nixon closed the gold window, he also announced a 90-day freeze on wages and prices. The point was not only economic management. It was political anesthesia. The freeze, followed by later control phases, helped suppress the visible retail consequences of the monetary break long enough to preserve public calm. Inflation did not disappear. It was delayed, redirected, and partially masked. The numbers show the lag clearly. Annual CPI inflation was about 4% in 1971 and 2% 2% in 1972, then accelerated sharply to 6%, 2% in 1973 and 11.0% in 1973 and 11.0% in 1974. The break had occurred in 1971, but the grocery store reality hit much harder later. That lag matters because ordinary people do not live inside monetary theory. They live inside timing. A family does not say, the reserve architecture has become internally inconsistent. They say, my paycheck still covers food. Then later, why is meat suddenly expensive? Then later still, why does every raise vanish? The system can survive the first phase because the loss is abstract. Confidence usually cracks in the second phase when the abstraction enters the weekly household budget. And the inflation wave of the 1970s was not caused by one thing alone. Price controls relaxed. Producer prices pushed through into consumer prices, and the 1973 oil shock intensified the damage. But that does not weaken the forensic point. It strengthens it. Once the anchor is gone, the system becomes more vulnerable to every subsequent shock. What would once have been a strain becomes an accelerant. This is the mistake people keep making in real time. They assume that if the supermarket is calm, the currency regime must still be intact. But in financial history, there is often a quiet interval between the policy rupture and the household recognition of what changed. That interval is when officials still sound credible, when nominal balances still look reassuring, and when most people make the worst possible decision. They keep measuring stability by yesterday's sticker prices, instead of noticing that the measuring rod itself has already been altered. Now bring that pattern into the present. The phrase Mar-a-Lago Accord is not, at least as of now, a signed global currency treaty in the way people speak about Bretton Woods or the Plaza Accord. It is better understood as a policy blueprint and market narrative built around the idea that the United States may seek a weaker dollar, a narrower trade deficit, and a partial reordering of who bears the cost of the dollar system. That idea has been widely linked to proposals associated with Stephen Moran, and to broader 2025 policy debates around tariffs, industrial policy, reserve burdens, and exchange rate pressure. That distinction matters because if you call it an accord too early, it sounds finished. It sounds coordinated. It sounds like a clean diplomatic event. What matters more for the forensic record is the incentive structure underneath. A strong dollar supports reserve prestige, but it also pressures manufacturing, widens external imbalances, and forces the issuer to absorb the contradictions of supplying the world's preferred asset. Once again, the reserve currency privilege becomes a domestic political burden. That is the rhyme with 1971. Not that gold convertibility is about to vanish tomorrow. That already ended. The rhyme is that policymakers are again confronting the costs of the system they inherited and are again tempted to solve a structural problem by changing the terms of the measuring rod rather than openly admitting the trade-off. In 2025, the dollar did in fact weaken sharply for part of the year. Large institutions described it as one of the steepest first-half declines in decades, driven less by simple rate differentials and more by slower U.S. growth expectations, policy uncertainty, deficits, and changing capital flow assumptions. That does not prove a master plan, but it does show that dollar weakness is no longer a fringe thought experiment. It has moved into policy discussion, market pricing, and strategic debate. And here is the signal viewers should watch. When officials begin talking as though a somewhat weaker dollar is not a problem but a tool, you are already inside the next stage of de-anchoring logic. The language will not be collapse. It will be competitiveness, rebalancing, burden sharing, industrial renewal, strategic adjustment, different era, different vocabulary, same temptation. When a system becomes too expensive to defend in its old form, the political class does not ask how to restore the old anchor. It asks how to make a weaker unit sound like a national recovery strategy. So what do you do with this record? You stop asking whether your balance is larger in nominal terms, and you start asking a harder question. Larger relative to what? relative to ounces of gold, relative to productive land, relative to energy, relative to housing in a place people still need to live, relative to ownership in businesses that can pass through higher cost without destroying demand, relative to tools, inventories, and skills that remain useful when the unit of account is being quietly degraded. This is what I mean by gold equivalent thinking, not asset worship, not panic buying, not the fantasy that one instrument saves everyone in every regime. I mean measuring your life against things that cannot be expanded by decree at the speed of political necessity. The survival guide is simple. Track your income in nominal dollars, but track your wealth in real benchmarks. Build a private dashboard. What does 1 month of your expenses cost in gold, in staple food, in rent, in kilowatt hours, in fuel, in insurance, in property tax, in replacement costs for the things your household actually depends on? Then watch the gap. If your account balance rises but your command over those benchmarks falls, you are not getting richer. You are being cosmetically compensated while your purchasing power is drained. That is the lesson of 1971. The danger is not only collapse. The danger is adaptation to a lower standard, while the headlines call it stability. Watch the signals, not the headlines, because in every de-anchoring cycle, two groups emerge: those who protect the number and those who protect what the number can still buy.